Welcome back. In the last session, we have discussed in detail about the key elements in a financial statement and how it is defined and what are the criteria for recognizing those five key elements. So, let us continue with the other aspects regarding the convergence of IFRS. Next one, criteria or principles of recognition, measurement, presentation, and disclosure of financial statement. So, in this head, we are going to discuss about how the items or the key elements of financial statement is recognized, how it is measured in terms of financial terms, and how it can be presented and disclosed in a financial statement. Previously, we have discussed in detail about the definition and what are the criteria for recognition, but let us discuss in detail all these heads. So, first of all, the principle of recognition. Here, the principle of recognition is with regard to revenue. We have learned about the principles of accounting in your commerce classes, that is in your plus one classes. You might have learned about the principles or concepts and conventions of accounting. So, some of the principles of accounting we have learned, and one such principle was revenue recognition. I believe you all know what is meant by revenue recognition. Revenue recognition is the cornerstone of accrual accounting together with matching principles. I believe you all know what is meant by accrual concept and what is meant by matching principles. So, they both determine the accounting period in which revenues and expenses are recognized when they are realized or realizable and are earned. That means usually when goods are transferred or goods are sold or services are rendered or provided, no matter what, when cash is received, so the concept is whenever there is a exchange of goods or services, that financial transaction is recognized or recorded whenever there is an exchange of goods or whenever there is a service offered from one party to another occur, and at that time it is considered as revenue or expenses, whatever it is, that the transaction is considered. But it doesn't mean that there must be a flow of cash from one party to another at that point of time. That is the main concept of revenue recognition and the principles of accrual concept. So, as per the accrual concept, there is no rule regarding there must be a flow of cash between the one party to another for the exchange of goods and services. Whenever there is an exchange occur, it doesn't matter whether it is for cash, and when exchange occurs between one party to another with regard to goods or services, it is considered as a financial transaction. But there is another view with regard to the same situation, that is in a cash accounting view. Cash accounting view means in the term itself mentioning cash. A revenue is recognized when the cash is received, no matter when the goods or services are sold or transferred. That is another concept. Usually in accounting or in the recording of transaction, usually we follow this as per the principle that is in the first paragraph, that details has been mentioned. That is, whenever there is an exchange of goods and services, it will be considered or recognized even if there is no exchange of cash occur at that time. That is a concept of revenue recognition basis, and it is mentioned in the first paragraph. But in cash accounting point of view, we consider an exchange only where there is a movement of cash flow from one party to another. So that is with regard to principle of recognition. So whatever the principle we are following, it has to be considered while recording transaction. The cash can be received in an earlier or later period than obligations are met. Obligations are met means whenever there is an exchange of goods and services. And related revenues are recognized that results in the following two types of accounts. One is accrued income, another is deferred revenue or deferred income. And accrued income means revenue is recognized before cash is received. That means the goods or services might have exchanged or provided, but the payment was not made. That is known as accrued revenue, and it is simply known as outstanding revenue. You might know the term outstanding because an amount which we are owed to receive. We have to receive, but we haven't received yet. That is known as outstanding. In accounting terms, we can use accrued revenue. Next one type of revenue is deferred revenue. That is, revenue is recognized after cash is received. That means the payment or we have received an amount for a sale or an exchange of good that is going to be happen. That is known as received in advance. I believe you know the term received in advance. Any amount received in advance for any exchange of goods or services, and before the happening of that exchange, we will receive the amount. That is known as amount received in advance. We use the term deferred revenue. So these are the two types of revenue situation that might come in a business, and as per the principle of recognition, you have to consider according to the nature. So any amount received after the exchange of goods, it is known as outstanding, or yet to receive is known as outstanding, and amount received in before or prior to any exchange of goods and services is known as advance, or otherwise known as deferred revenue. So this is how you have to recognize the revenue in a financial transaction. Apart from that, the IFRS provides 5 criteria for identifying the critical event for recognizing the revenue of the sale of goods. So let us discuss those 5 criteria. So now we have discussed about the exchange of goods and services. So now we are going to discuss the 5 criteria that is mentioned or identified by IFRS with regard to sale of goods. So what are those criteria? First one, we recognize a transaction as a revenue when risk and reward have been transferred from seller to the buyer. That is first one. Whenever there is an exchange of goods and the payments have been transferred from the seller to the buyer. Next is the seller doesn't have any control over the goods sold. We all know that whenever the exchange of goods happens, the whole control of the goods will be, or ownership will be transferred from seller to the buyer. In that case, the seller doesn't have any control over the goods because it is already exchanged. The collection of payment is reasonably assured. We have mentioned that in all the exchange of goods, it doesn't mean that it should be supported by a cash at that point of time. Either the payment may be received in future or whatever on the basis of their agreement between buyer and seller. But it should make sure the payment is reasonably assured. Assured means the payment should be received without any failure. The cost of earning the revenue can be reasonably measured. Any expenses that is made by the seller with regard to the sale of goods for which it should be properly measured and recorded. The amount of revenue can be reasonably measured, just like the point which we have discussed in the last line. The amount of revenue relating to that particular sale of goods, it should be reasonably measured, supported by financial documents. Financial documents in the sense means vouchers, bills, receipts, like etc. So these are the 5 criteria that has to be considered for recognizing a revenue with regard to sale of goods. We all know that what is meant by sale, that means exchange of goods and services from buyer from seller to the buyer. That is known as sale of goods. But in the financial point of view, we need to recognize the sale of goods with regard to revenue on the basis of various criteria. So those were the criteria we have discussed now. So on the basis of these criteria only a revenue is recognized. With what? Relating to a sale of goods. So next one. Earlier we have mentioned about how a revenue is recognized with regard to sale of goods. Now we are going to discuss the recognition of revenue from 4 types of transactions. So let us discuss some of the type of transactions from which a revenue is recognized. First one, a revenue from selling inventory are recognized at the date of sale, often interpreted as the date of delivery. So whenever there is a sale of goods, inventory means goods in the sense means inventory may be stock or goods or work in progress or finished goods, whatever may be. So whenever there is a sale of inventory or selling inventory and the revenue is recognized from that sale, and at that date often is interpreted as the date of delivery. That is the first one that has to be considered while identifying a transaction. So the date of delivery of goods from the seller to the buyer, that has to be identified, and that date is known as date of delivery. Next one, revenue from rendering services are recognized when services are completed and billed. Completed and billed means the transaction should be complete. A half transaction or a part transaction cannot be considered as a complete financial transaction and can't be recorded. We can record a transaction only and when it is complete. Next one, revenue from permission to use company assets. Is recognized as time passes or our assets are used. In simple terms, we can say we can lease the assets of companies for some business purposes. There are many companies that provide their capital assets or their fixed assets to other businessmen or other companies for usage. For that, the company who is offering the assets will charge a certain amount of fees or an interest. So revenue from the permission to use a capital asset is recognized as the time passes or the assets used. So whenever we acquire the assets of a company for our business purposes, the company that offered assets to us, they will charge certain interest, and that interest is charged on the basis of the time period or the hours for which the machine has been used. So it has to be recognized properly. That is another point. Revenue from permission to use the company asset. Company asset means assets of any company is recognized as time passer because the interest or the fees charged on the usage of an asset is based on the time it is used or the basis of hours it is utilized. Next one, revenue from selling assets other than inventory is recognized at the point of sale when it takes place. We have discussed about the sale of or the exchange of items from seller to buyer, and in some situation you might sell the assets other than the stock or any inventory. In that case also you need to consider a transaction as a revenue recognized transaction at the point of sale. Point of sale means whenever the assets are exchanged from seller to the buyer. That is known as a transaction that is recognized as a revenue transaction or revenue generating transaction. Next one, as per the heading, we have discussed now the principle of recognition. Next one, the principle of measurement. Under principle of measurement, It is the process of determining the monetary amount at which the elements of the financial statements are to be recognized and carried in the balance sheet and income statement. That means how to measure an item for financial reporting purposes. There are five key elements with regard to financial statement, how it is measured from the financial point of view. We have to measure, or first of all, we have to measure those items from the materiality point of view, and it shall be assessed in relation to the financial data. In making assessment of materiality, it shall be recognized that measurement may rely on estimate to a great extent. The measurement procedures to be followed in financial report shall be designed to ensure that the resulting information is reliable and that all material financial information that is relevant to an understanding of the financial position or performance of the entity is appropriately disclosed. Sometimes the items may be identified in financial terms, usually on the basis of estimation. And even if it is done on the basis of estimation, it should be supported by reliable and fairly supported documents. While measurements in both annual and interim financial reports are often based on reasonable estimates, the preparation of interim financial report generally will require a great use of estimation methods than annual financial report. I believe you all know what is meant by interim financial report and annual financial report. Financial statements or report that is prepared on the basis of financial statements. We all know financial statements are prepared once in a year, that is at the end of the accounting period. Any statements prepared in between two accounting period is known as interim financial statements. For such financial statements also you need to prepare reports. So such reports are known as interim reports. And in the case of annual reports or annual financial statements, you will have some sufficient documents or supporting information to properly estimate the value of an asset, and such estimations will be almost reasonable and correct. But in case of interim report, you have to prepare the statements on the basis of fairly on the basis of estimates. So when it compared to the reports or statements of an interim statement when compared to an annual statement, in case of interim statement there will be more estimates rather than the annual statements. So we all know the key elements of financial statements are assets, liabilities, equity, income and expenses. And all these items has to be measured properly, fairly and correctly. So how these items can be measured? There are certain categories for which an items in a financial statement can be measured, and one such item is with regard to assets and liabilities. So how you are going to measure one of the key elements in a financial statement, that is assets and liabilities. One such method to measure the assets or liability is on the basis of historical cost. We all know what is meant by historical cost. We have learned about the historical cost concept in one of the accounting concepts in +1 commerce. I believe you all know one of the basics of accounting concept, that is historical cost concept. That same concept also implies the historical cost, that is it is a price paid to acquire an asset or the cash or cash equivalent received against the obligation. If I own a company, I might have purchased an asset last month, and if I record the value of the asset at that price means at the purchase price of that particular asset, it is known as historical cost, because it is a cost that is incurred on an asset at that point of time. That is known as historical cost. So it is a price paid to acquire an asset. With regard to asset, if you have paid a certain sum to acquire an asset, and if you are recording that amount in the statements, it is known as historical cost. Why it is mentioning that if you are recording that value in the statement? Because if I own a company, I might have purchased the asset in January, but I prepare the financial statements on December. So if you check the value of the asset on January and December, definitely it will not be the same, because the amount paid on January will be the price paid for the asset, and by the December the price of the asset might have raised or reduced. But we are not going to record the present value of the asset. We are recording only the price which we have paid at the point of purchase. That is known as historical cost. So that is with regard to assets. Assets can be recorded at historical cost. Just like that, we can record the liabilities also on the base of the amount which we have borrowed at that point of time. That is known as liabilities. For example, I might have borrowed certain sum of money from the bank, and its monetary value may be something, and by the end of that year, if I plan to borrow or plan to take a loan from the same bank, the monetary value may be much different from the monetary value which I have obtained the loan at the beginning of the year. So there will be variations in the interest rate as well as the monetary value with regard to the loan at two different periods. If I am going to collect the same from the same bank, definitely it will be like that. And the January, the money rate or interest rate will be different when compared to the money and interest rate by the end of the year. So in case of liabilities also, you need not have to worry about the present market condition. Just record any liability at the rate in which the amount has been obtained from that point of time. If I have borrowed 1 lakh rupees from bank on January, just record the detail for the transaction that happened in January. Don't consider the present bank statement or present bank rates or present bank values. That is with regard to liabilities. Next one, current cost or fair value. It is a current entry value of an asset if replaced currently. I have mentioned that I might have bought an asset in January. If I want to purchase an asset in this month, definitely the value of asset will be different. So if I am recording the asset in a financial statement, I can follow any of these attributes. If I am following current cost or fair value concept, I have to record the value of the asset that is prevailing at that point of time. So that is known as current cost or fair value, and that is with regard to asset. For liabilities, it means the undiscounted amount of cash or cash equivalent that would be required to settle the obligation currently. Here the undiscounted amount of cash or cash equivalent means you will learn about that discounting cash flow concept in your future classes. Discounting cash flow concept means the value of money will never ever remain the same. It keeps on changing. The value of 1 rupee today will be different when compared to the same value that is measured in the next year. It will be different. That is, the money value keeps on changing, and with passage of time there will be a reduction in the value of money. That is known as discounting cash flow or discounting concept of money. In simple terms, you might have heard the term time value of money. That is, the value of money keeps on changes with the passage of time. So here current cost or fair value, I believe you have understand the concept with regard to asset. With regard to liability means whatever the discount situation of the cash flow or whatever the rates present prevailing in the market, it doesn't matter what is the value of that obligation at that point of time, at that current period. That has to be recorded, not the amount or the value or the interest rate that was fixed at the time of acquiring the liability, liability in the sense means loan or any other credit facilities. That is known as current cost or fair value concept. Next is realizable value or settlement value. From the term itself, you can easily find out the concept. Replacement cost is the price that would be paid to acquire an asset with equivalent service potential in an orderly market transaction at the measurement date. Or we can simply say it is the amount at which an asset could be realized. If I am going to sell an asset, I will get a certain value for the asset depending upon the life, depreciation, whatever it is. That is known as realizable value with regard to asset. Settlement value means if I am going to settle any loan or any credit facilities availed from any bank or any creditors or financial institution, what is the rate for which I am going to agree with the lender or the creditor or the bank. That value is known as settlement value. How a liability could be liquidated. Liability could be liquidated means how a liability can be settled or how a liability can be paid off. That value is known as settlement value. It doesn't have any relation with time or rates. And finally, the present value concept. It is the most important concept, and I have mentioned about the time value of money previously and that concept relating to present value. So I believe you understand the concept of time value of money. With passage of time, the value of money changes. So with passage of time, the money value changes. So you need to identify the present value of money at each point of time, because it is very important to identify the actual cash value. Because if there is any change or deduction in the value of the money from passage of time, you need to exactly identify the rate at which the money is discounted. Just like the depreciation, discounting of cash flow means reduction in the value of money. With passage of time, the money value decreases. That is known as time value of money, or in simple terms we can say discounting value of money. In such cases, we have to identify the present value of money. What is the value of money at that point of time? For example, I might have borrowed 5 lakhs from, or I might have invested 5 lakhs in a share market, and there will be a cash discounting cash flow concept at a 10% per annum. That means in each year there is a reduction in the value at 10% rate. That is known as discounting value of money. So I need to identify what is the value of money in each period. That is, if I have invested 1 lakh rupees in a share market for 5 years, I need to find out the value of money in the first year, second year, third year, fourth year and fifth year. After identifying the present value of money for each of these 5 years, then only I can exactly identify the actual money I am going to receive in the fifth year. That is known as discounting flow of money or discounting concept of money, or in other terms we will use the term present value. So in present value concept, the asset is valued at the discounted value of the future cash inflows that asset expects to generate in the normal course of business. I have mentioned that point right now, and some of you might get confused with the discounting flow of cash flow. Don't worry, you will learn about the discounting cash flow concept in your higher studies, and we will discuss about those aspects with practical cases at that time. Now just understand that whenever there is a change in the value of money with passage of time, it is known as discounting cash flow, and change in the value of money means reduction in the value of money. That is known as discounted cash flow. It is just almost similar to the concept of depreciation on an asset. So in case of present value concept, if you want to value the asset of a company, in that case also you need to identify the present value of that asset in each of these periods. And on the basis of that only we can easily identify the present value of asset after a certain period of time. And with regard to liabilities also, liabilities are carried at the discounted value of future net cash inflows that are expected to be carried to settle the liabilities in business. That means I might have borrowed certain sum of money from certain person for a period of 5 years at certain percentage of interest, and I need to identify the value of liability for each 5 years. It may be on the, if it is based on the discounting concept, I have to identify what amount has to be paid in order to settle the liability after the certain period. But it doesn't think like that. Means a discounting factor of liability means the amount paid by you keeps on reduce or keeps on diminishing from one point on. It doesn't mean like that. Your money will, the value of the money will be diminished from one point of time to another. So after 5 years you have to pay that much money, so that the discounting factor has to be considered, and also the total amount that has to be paid at the end of the 5th year. So don't think that for the liability you have to pay less. You need to pay after considering the present value concept, and at the same time the total principal amount and the interest value. Don't get confused with that. Just understand the concept that these are the criteria for identifying the assets and liabilities while recording in a financial statement. We will discuss about these net cash flows or present value of cash flow and present value of assets and liabilities in your higher studies. Higher studies means in your coming semesters we will discuss in detail these points along with the practical cases. Anyway, these are the 4 criteria for identifying assets and liabilities. I will just repeat these points once more. Historical cost means the value for the assets and liabilities at that point of time. Whenever you acquire an asset at a certain point of time, what was the cost paid for the asset? That is the value you are going to record in the transaction. That concept is known as historical cost. Just like it is almost similar to the concept of in case of a liability also. If you might have borrowed a certain sum of money from certain person, record the value of liabilities at that point of time. That is known as historical cost. Current cost or fair value means what is the value of that asset that you are holding right now. The market value of that asset right now may be different rather when compared to the historical cost. So if you are recording an asset from the fair value concept or the current, what is the prevailing market value or the prevailing current cost, if you are recording at that value, it is known as current cost concept or fair value concept. Whereas realizable value or settlement value means at what rate or at what value you are going to purchase the asset, or are you going to liquidate a liability. So realizable value usually in case of asset means usually whenever you are going to sell your asset, for what value you are going to dispose your asset, that is known as realizable value. And settlement value is a value for which a liability is liquidated or disposed. How you are going to repay the liability, or what is the rate at which the liability is going to be repaid, that is known as settlement value. And finally the present value, I have mentioned earlier, it is based on the concept of time value of money. You have to record, if you are recording the value of an asset or liability in the financial statement as per the present value, that means you need to consider the prevailing discount factor of the cash inflows. So these are the main attributes for recording assets and liabilities in a financial statement. We will discuss about other types of measurement and attributes of the other key elements in the financial statement in the coming sessions. So go through it. If you have any queries, please let me know.